slow again? Okay. Right. Okay, so I'll just check you guys can hear all right. How's sound over in this part of the world? Is it okay for you guys? Yep. Good. Was that more? You want more? Okay. How's that? Is that better? Good. Okay. What about you guys at the back? You okay? Oh, I think that's a nod. Kind of hard to tell at times. You guys okay for sound? Yep. And you guys are not part. Okay. Okay. So tomorrow is actually a review lecture. So I've already had several questions come in, but if you do have questions you want answered in that lecture time, send them to me as quickly as you can, and I'll try to put some slides together for tomorrow's session. Today we start the first of our two topics on the capital markets, and the bond market is going to be our first one of the capital markets. And capital markets, when you listen to economists talk or you read what they write about economic development, how the world came to be as it is, they place great store of great importance on the development of the capital markets. They initially were developed in Europe, Amsterdam first, and then spread to several other places throughout the world. And out of that has come a time of enormous prosperity when you compare to previous periods in history. Now, one of the things that when we think about the role of capital markets in the development of an economy and development of prosperity in the world, that we ought not to lose sight of is simultaneously at the same time, there was enormous developments within science, and then from that science came engineering and technology, and businesses grew up out of those things as well. But within the economic world, the role of science, of technology, of engineering is often either poorly understood or completely ignored. And to give you an example of how badly it can be ignored, a few years ago, probably 3 years ago, the New Zealand Treasury hired a new chief economist. So he's a new kid on the block. And he came to visit all the universities in New Zealand, and his purpose in visiting was to try to encourage some collaboration between Treasury and the universities to improve the quality of the advice that they gave to the government, because that's part of their role as the Treasury, is they give policy advice to the government, and so when the government has an idea, they would evaluate it and give them policy advice about that. And so his visit was considered to be of such importance that the Vice Chancellor said that all of us within the department had to attend, and of course I dutifully went along to listen to the man. So he spoke for about half an hour, and then there was another probably hour of discussion around what he'd said. And throughout the entire period, probably about an hour and a half, it was all about regulation, markets, policy settings, and all that sort of stuff. And the role of science, technology, and engineering, simply those words were not even mentioned at all. And so we should bear in mind that when we talk about capital markets and we think about how important they are, that at best they can play a facilitating role in the development of the economy. At worst, they can actually be a hindrance, but often they're not what drives the economy at all. Now, when we think about when these things developed, they were developed first in Europe in the form that we know them, and then from there they spread elsewhere. And Amsterdam was really the first city that had a capital market of any sort in the modern sense of that word. Now, it wasn't a foregone conclusion that capital markets would develop, and certainly there was no foregone conclusion that they would develop in the form that we have them today. And if we think of like the bond market, because there's two capital markets. There's basically a debt market, and then there's an equity market. In the bond market, we think when you make a loan, you simply charge interest. That's just normal practice. We live with that every day of our lives. We've grown up with it. It's just normal for us. But it wasn't always normal. There was a long period of history where the charging interest was frowned upon. Here's a partial list of religious leaders, statesmen, and philosophers who said that this was something horribly bad. Moses, Plato, Aristotle, Cato, Cicero, Seneca, Thomas Aquinas, Muhammad, and Buddha. Okay, that's just a partial list. There's plenty more. And when these capital markets started to develop, as you can imagine, there was a considerable disagreement about whether they should be allowed to develop at all. And one may ask the question, well, there's a great list of people there over some long period of time who opposed it. Why were they against the charging of interest? Because it's clearly what they said. In fact, one of them, I think it was Cato, compared the charging of interest to murder. He put them in the same sentence. You ask me what I think of usury, that's charging of interest. Ask me what I think of murder. That's what he basically said. And why? Why do they think this? Why do they think this is so horribly bad that it should never be done? And unfortunately, most of them don't tell you why. But one of them does. That was Aristotle. He actually tells us why he thinks this is bad. And his argument is relatively straightforward to understand. If you consider the case, say you lived out in the countryside, you grew wheat, as that was your business, and your neighbor wanted to borrow from you some wheat seed. And they're going to plant it, grow some wheat. He could see that at the end of the growing season, he should pay you more than he borrowed. So maybe you get if you give him 1 sack, you get 2 sacks back in the end, because wheat was something that would reproduce itself. You know, you plant the seed in the ground, it'll grow, you get more wheat. He could see that. He thought that money was sterile. Okay, it could not reproduce itself, and therefore, if you loaned money and you charged interest, you were making yourself richer at the expense of whoever borrowed it. And this was morally wrong, at least in his opinion. And not only in his opinion, in the opinion of many others. So when this started to happen in Europe, this issue of not only what's the right rate of interest, but should we do it at all, was a very contentious issue. And in fact, even if you're interested, it actually turns up in one of William Shakespeare's plays. So if you're keen on William Shakespeare, in The Merchants of Venice, there is this exact issue. The basic story there is that Bassanio wants to chat up Portia down the road. She's a very beautiful woman. He doesn't have any money, but his friend Antonio, who's rich, would provide him some money so he can go and court Portia. Now, unfortunately, Antonio, although he's rich, he's got a cash flow problem. Sound familiar? Liquidity problem. And so he goes off to a moneylender by the name of Shylock, and he wants to take out a 3-month loan. So definitely a money market transaction there. And they have this discussion in the play, in some of the most beautiful poetry ever written in the English language, about the interest. And you would think, from our point of view, well, what they're trying to work out is, what's the right rate? But that's not what they're talking about. They're talking about this issue, should you charge interest at all? And Antonio, who in the play is portrayed as a Christian, he says, no, you shouldn't. This is morally wrong. Shylock, who was a Jew, said, yeah, I want to. And within his religion, because within his religion he could not charge interest to fellow Jews, but he could charge interest to outsiders, he was within his right to think about, charge Antonio some interest. Now, ultimately, what they decide is not to charge interest. And, of course, that sets up the rest of the play. Special conditions that he puts on the loan, drives the play for the rest of the period. Now, when Shakespeare wrote that, that was around 1596, thereabouts. That exact issue was actually something that was going on within British society. And there are 2 occasions, not just 1, 2, in which the British Parliament passed a law forbidding the charging of interest. Now, obviously, if they passed it twice, it had to be repealed once, at least. And when you think about that, they passed the law, and then they repealed it, and they didn't think, man, that was a dumb idea. They went and they passed it a second time later, and of course, they repealed that later. And this contentious issue about should we be allowed to charge interest at all was, that was what the core problem was. Some people were, a lot of people, in fact, enough people within Parliament thought it was sufficiently wrong that they outlawed it. Now, ultimately, all this stuff eventually, somehow, got sorted out. And we got to the capital markets that we have today, where people like you and I just think that charging interest on loans is normal. That's just part of life that we live. But this year I don't have my Malaysian students. They're restructuring their program. So they're not coming this year, but they're coming next year. But typically I would have 40 to 50 Malaysian students in here, and they're all Muslims. And within the Muslim religion, you can't charge interest there. And so when we talk about this stuff, I have to be very careful because to them it's quite offensive. So this stuff hasn't gone away completely. But ultimately, and I'm not really sure how it happened, this issue of the charging interest was essentially settled. And you don't see religious leaders opposing it today, you don't see philosophers opposing it, you don't see statesmen opposing it anymore. It's simply become part and parcel of how we do our economy. But there's no guarantee that this would have happened. It could have easily swung the other way, and we would not have capital markets in the form that we have them today. So that's just a bit of background to these things. So this is an outline of where we're going. I'm going to talk a little bit about the capital markets in general, then specifically what's a bond, some types, government bonds, and then some private sector ones, the bond markets themselves, junk bonds, very interesting thing, credit enhancements, which we talked a little bit about in the previous topic, and then securitized instruments and regulators and other global markets. So that's where we're going over the, should take today, then Friday, and then Monday. So we'll start off with the capital markets. Okay, so when we're thinking about the capital markets, why do we have them? What is the economic purpose of having a capital market? Why do we have capital markets? We know why we have money markets. What's the reason for having capital markets? Yeah, go ahead.
Compared to the money market, the capital market is long term, so you kind of a long-term investment.
Okay, long-term investment.
Kind of like short-term liquidity and something like that.
Okay, so money markets just for liquidity management. So capital markets for long-term investments. Anything particularly we want to do with that long-term investment? Yeah, go ahead.
Invest in fixed assets, so you match the term of the bond you're issuing into the capital market to the expected lifetime of the fixed asset you want to purchase with the funds you raise.
Okay, so the basic point there is that these markets are for the raising of capital for long-term productive investment. So like some fixed asset, it's going to have a long lifetime, say building a new factory or so, something like that. And when you have some long-term investment, it's going to take a while to earn a return on it. You want to borrow your money for a long time, or in terms of the equity market, you actually get an ownership share. So that's the primary purpose of it, is the proceedings are invested in the capital items, plant, equipment, buildings, things that are going to be around for a long time and going to increase our productivity. Now, on the other side, governments issue long-term bonds to fund their current expenditure. But in general, this is what it's for, long-term productive investment. And this is why people think that it drives economic growth, because if you want to increase grow the economy, you need long-term investment, and this is where the money is raised from it. So we look at who issues these instruments. Households and the mortgages are actually considered to be a capital market instruments, and so the biggest issuer of those is households, businesses, bonds, and in the next topic we'll talk about common stock, and then governments are another major issuer, particularly of bonds. They don't issue stocks at all. And in terms of investors, most of the big investment comes from households, either in one form or another, either directly in buying bonds or through a collective investment vehicle. Now, in one sense, foreign investors are exactly the same, it's just they don't live here, but they're often considered to be a separate group. Now, there are two types of capital markets. There's the debt markets, which is bonds and mortgages, so the two debt ones. And then in the next topic on the equity markets, what you're actually doing in equity is buying a part ownership in the business. So if you buy a share of stock, then you're buying a part ownership in that particular business. Okay, any questions on that before we move to exactly what is a bond? Okay, everybody's happy. Right. Okay, so what's a bond? Any distinctive features that we can say makes a bond rather than something else? Long-term debt, yeah. Basically, we say anything from a year and longer as a capital market instrument, that tends to be a bond. Okay. Long-term debt, anything else? Yeah, go ahead.
Usually has a set maturity date, but the debts which can sometimes be flexible.
Okay, so usually a bond has a set maturity date. Yeah, that's a common feature, set maturity date. There are things that have no maturity date, but there are not very many of those around. So the common feature is they have a fixed maturity date when they come to the end of their life. Anything else about them? Okay, well, let's roll over. We said a bit about the loan debt. So when you actually pick up a bond prospectus, and these things tend to be quite thick, the key things are who issued it, so that's who's borrowing the money. So the issuer is the borrower, and basically how much each one is worth. Now, because if it's a zero coupon bond, you're going to buy it at a discount. Typically, if you get to the coupon bond, you actually buy it at face value. When it expires, and basically that's when they get repaid that final amount. Now, one of the things about most of them is that they'll have a fixed coupon rate. We've talked about this before when we talked about bond pricing. Not all of them do have a fixed coupon rate. Some of them will have a floating rate, but the majority of them, they're fixed, so that doesn't change over the life of the bond. And in terms of the frequency, very common for them to be semi-annual, that's twice per year. But in New Zealand, because a lot of the issues are aimed at small investors, it's quite common to see quarterly payments in New Zealand, and that's to try to attract small investors and gives them a more regular payment. So here's an example. You buy the bond today, because it's a coupon bond, you're paying full face value, $1,000, and this has got a $80 coupon, which based on that, that's an 8% coupon rate. And you get two payments of the coupons, and finally, you get your final coupon plus the return of capital at the end. So that's the basic structure of the bond, which we've actually met before. Okay, any questions on that before we move on? Okay, everyone. Okay, I did actually make some minor changes to this section here. I've actually reordered something. So if you got some of the early version, you'll find things are in a different order. So we're going to look at the Australian Treasury securities. So these are government bonds. So go look at three of them: the government treasury bonds, the notes, and the treasury index bonds. Any distinctive features that you can think of or have met, come across with respect to any of those? Let's take the top one, the treasury bonds. Any distinctive features about them that you know of? What's that? Risk-free. Yeah. Okay. And when we talk about risk, I mean, there's a whole range of risk. Which particular risk is it supposed to be free from? Yeah, default risk. So when we're thinking of the risks that we face as a bondholder, just because it's a government bond, we still have interest rate risk that we have to take account of, particularly in the long-term ones, but it's considered to be free of default risk. Anything else about them? Long-term to maturity. Do you know how long the Australian ones go out for? Yeah, 30 years. In fact, I got some data. I was going to show it to you later, but I must show you now. These are the Australian bonds on issue at the moment. And these are maturity. They've just issued a 30-year bond. So this matures in March 2047. So this is their range of maturities. Next one to be matures is only in July, runs out. And these light-colored blue ones here, these are the ones being issued in the last 9 months. So they have quite a wide range, and the maximum is 30 years at the moment. Let's see if there's anything else we missed in here. Ah, yes. This is something that's often said. Well, it's not often said, but it's said from time to time that the bonds and notes are backed by the full faith and credit of the Commonwealth government. In fact, when the U.S. government debt was downgraded a few years ago now, then President Obama said that the U.S. government debt was backed by the full faith and credit of the U.S. government. Sounds really good. What does it mean? Sounds impressive. Low default risk. How are they going to achieve low default risk?
This is pretty much definitely going to pay back.
You're definitely going to pay back? So how are they going to pay it back? I mean, you're on the right track, yeah. I mean, it's basically, this is the thing that says we won't default.
And say that Reserve Bank is the bank of the government. They can create the money out of nothing. So pretty much they can pay any amount of money back.
Okay. Well, while that's actually true, while that Reserve Bank can actually create money out of nothing, they will not actually be the ones paying this back. Okay, and so the fact that they have a Reserve Bank that actually create money out of nothing isn't what makes it default risk-free, and it's not what's meant when they say it's got the full faith and credit of the government behind it. Okay, so basically, I mean, it's a very, wonderful sounding term. All it really means is that because the government has the power of taxation, that they will use that power of taxation to get the money they need to pay it back. So when you think about what happening in a democratic society, you have a democratically elected government who is incurring debt on behalf of its citizens. It basically is saying, we as the government will guarantee to pay this back, and we will simply tax people to the extent that is necessary to repay this. So that's really what it means. Now, of course, in reality, if you can get some extreme situations like you got in Greece, where if you try to tax people, they'll actually go out and riot and revolt against you, sometimes even overthrow governments. But that's the basic idea, that the power of taxation is sufficient that they can always repay their debts. Okay. Let's see. What about this bottom one here, the Treasury index bonds? Any special features of those? Yeah, go. Oh, did you have a question, or did you? A question.
Will they manipulate? Would that be some other person, but would that be ethical?
Ethical. To tax people.
Yeah.
Well, we tax people now, so it must.
So it says that you're going to impose on persons to meet some obligations that you made in the past because you're afraid of this fall. It's just like,
Yeah, I understand your point. I mean, when it becomes an issue, like it did become an issue in Greece, then the people are already in a miserable state. There was, in Greece, I think the unemployment rate was like between 25 and 30%, and they were starting to go into default. And the question there is it moral to then raise the taxes? That's your basic question. Yeah. Well, that's an ethical issue. I mean, it's one of those things. Governments get themselves into deep trouble at times. And in one sense, it's up to the electorate to ensure the government doesn't misbehave. So the fact that they did, in one sense, that people are responsible for that. Whether it makes it morally right to tax them higher, maybe it's not. I don't really know.
that's what's your opinion.
Yeah, well, it's definitely I don't really know. It is. I mean, I have thought about it, and it does strike me that when you get into trouble like this, that taxing extra hard is actually a bad idea. It does strike me as that's a big bad idea. But these sort of problems don't develop overnight. They're over a long period of time. And when you look at like what happened in Greece, you can look back and see that they were incurring far more debt than they should have for at least 10 years or more. And so in that time they had several elections, and because the people themselves put the same government back in and they incurred more debt, there's a sense in which the people are responsible for that debt. thorny issue. Thorny issue. Maybe I should put it in the final exam. No. Actually, I have done that. No, when students have asked me really good questions, one of them, more than once, I've actually put them in the final exams when I got a really good question. I promise I won't put that one for you. Okay, any other questions? Okay. So, sorry, we were on Treasury index bonds. Anyone know any distinctive features of these things? Yep, go ahead.
They'll be adjusted for the rate you earn will be adjusted for inflation. So the difference between the rate on the index bond and the rate on the regular bond would be the estimated rate of inflation for that period.
Okay, so the key feature of these bonds is that their face value gets adjusted for inflation. So when you're thinking about, if you think back to when we did stuff on the Fisher equation, the Fisher equation was a way to handle the fact that we have expected inflation. Now, if inflation is taken care of for you by the bond, okay, because as part of the structure of the bond, every time the CPI comes out, they'll update the value of that bond, then you simply can ask for the real rate, because you don't have to worry about inflation. That's a key feature of them, and one of the reasons they issue these things, apart from the fact that probably nice things to have in high inflation times, is that it allows the financial markets to see the real rate at the time, when it's issued, and then of course they'll trade it at a real rate in the secondary markets. And it makes that visible, whereas in most cases you can't see the real rate because you have to have something in there for inflation. Now, these ones, they have a gotcha in them, which makes it not quite as useful as you might hope, and that is they tax that adjustment of the value of the principal. Okay. So if you had 2% inflation and you got, say, $1,000 worth of bonds and you got $20, they would tax that $20. But even so, it's actually better than having nothing.
So I have a question.
Yep.
Also, the Treasury notes is kind of in the money market.
Treasury notes, yeah. They're often. Now, it depends where you are in the world. In the United States, a Treasury note is something that has a maturity between 1 and 10 years, whereas a Treasury bill in the U.S. is the money market security. Yeah, flip over, let's see if there's any. Okay. Actually, I didn't put anything about them. I know what I'll do. I'll take that out for next year. Okay, so let's see if we missed anything in particular. This bit here, simply a competitive tender. And so that means to us that once they have set the interest rate by competitive tender, then this is a fair market rate, an equilibrium rate. You have a question?
In one of the slides, in slide 17, you say that Treasury bonds are coupon instruments, so you earn money, like through coupon payment.
Yeah.
And the Treasury notes are like discount securities, so it's the difference between like what you buy for. Is that different for every country? So this is just for Australia?
Yeah, this is Australian ones. Where is that? So you reckon? Oh, you got the old 17. I reordered them, so I'm not sure where I put that. Yeah, I can't actually see it. So, right. No, can't actually see it. Anyway, okay, I will make sure this is better for next year. There it is. Right. That's right. They're discount securities. Yay! Found it. Okay. So that's the difference. They're discount security. Because one of the things about the zero coupon bonds, they have some very nice properties if you're a bond fund manager or another investor. And they're actually having zero coupon bonds is actually really useful. In fact, it's so useful. There's actually this little, well, it's not little, there's a big industry in the United States taking bonds apart and turning them into zero coupon bonds. So an example where they would do this, say you take a 10-year Treasury coupon bond. So over the life of that bond, it'll make 20 payments, 19 of just the interest, and the last one will be the interest plus the par value at the end. There's an industry of taking those apart and turning those into 20 zero coupon bonds. And there's actually money to be made. So you buy regular bonds from the government, turn them into 20 zero coupon bonds, and you can make a profit doing that. There's an industry doing that. So having zeros are really quite useful. Okay. Right. Yeah, there's a bit about the competitive market, so we get a nice equilibrium interest rate. And there's some stuff about New Zealand market. New Zealand, of course, is running a budget surplus at the moment, and you can see that their plan is to issue $7 billion this year. That's this year, and to repay 11.3. So they're actually reducing the amount of it on issue. Big market to get started. If you want to buy in the primary market, $1 million there. But once you get to the secondary market, you can get them in smaller quantities. So if you're a private investor and you want to invest in this market, you almost certainly have to go into the secondary market to buy them. They do have this other program called the Kiwi Bonds with a much smaller minimum, which is aimed at the private investor. So if you do want to buy government bonds and you don't have $10,000, you can go into the Kiwi bond market and buy them in much smaller pieces. Yeah. So when you look at the Treasury index bonds, there's quite a chunk of them outstanding, over $30 billion worth. And for the financial markets, these things are really quite useful, not only because they're a good investment if the inflation is high, but also because it allows this real rate to be seen. Okay, any question on that before we go to the turnover? Okay, so what's happened to the turnover in the Australian Commonwealth Government securities? And what's happened there? What has happened over time? And also, probably, why is this important to us? What's happened to this trading in this market? Yep, go ahead.
First is set out like comparison with the other securities. You can work out that consider that the government bonds they are risk-free, so you can work out the other securities risk premium.
Okay.
And the other thing is that also that is kind of how the Reserve Bank to manage the ESA account, so that
Okay. Yeah, I understand both points. Unfortunately, they're off the mark. Okay. Yeah, you got a question or a comment? Yep, go ahead.
Bond turnover has fallen in terms of the number of times that bond will be traded.
Yeah. So so the basic deal is the average time the bond has turned over a year has gone down. It's been going down. In fact, in the period for which the data is available, and I'll turn it over soon, it's dropped by about half. So what's the consequence for financial markets of the fact that the turnover has gone down?
Increased liquidity risk.
Okay, increased liquidity risk. So liquidity risk is real, and that, of course, will mean there's some additional liquidity premium. Any other consequence, or was that the main one? Okay, so that's a key one, is that liquidity has gone down in these markets. And they were already less liquid to start with. Now, that data is getting pretty old. And that's what I was going to show you this one here. So this is the more recent data, and you can see here like 34 billion for the one at how long it is. That's 9 years now. The amount of on issue from the Australian government has simply risen because they've gone into budget deficit in recent years, and they've had to issue more debt to simply finance the deficit they have. And unlike us, we were back in surplus. There's no real sign that they're going to go into surplus anytime soon. Now, they now issue out to 30 years. So you can see here, March 2047. And so the volume on issue has gone up, in the last sort of, well, since this other data was produced. But one of the key things that has happened is that this liquidity ratio has gone down. And when we look at, here's some, again, this data is pretty old, but I couldn't find any more updated stuff than this. If we add these two things together, so this is government bonds here, and you add that together with the non-government bonds, you come up with, this is the turnover in these markets, you get about 2.3 trillion down there. And so this is like the government, and then there's private sector ones here, $2.3 trillion per year turned over in these markets. If we go and look at the money markets, this particular thing was in the previous section as well, there are several segments which are larger. Trading in the bank bills, 3.2 trillion versus 2.3 for the entire bond market. In the repos, 3 trillion there, almost 3 trillion there. So we can see there's a significant difference in liquidity of these bond markets compared to the money markets. And so it's just a general fact of life that in these markets, liquidity is much lower. Now, if we go to New Zealand, let's just go. Can I escape out of here just a minute? If we go to New Zealand not government bonds, here's the debt market for New Zealand. This is actually an exchange market. I might update this thing here. So here's the securities that are being traded on this market, and these are this here. This is the codes, who the issuers are, and we can see when we look down at the volume that there's quite a lot of these that are zero. So although we're up to middle of the trading day, a lot of these bonds haven't even traded. So let's take this one here and have a look at it. This is Auckland International Airport, and there's some details about it. It's type, price, maturity date, and so on. When we look at the trading status, no trades today, but not only is there no trades, there's nobody wants to buy and there's nobody wants to sell. So we're looking at quite an illiquid market. And if we look at, has it traded? And this goes back about 6 weeks. There's been a few trades. Mostly where you see these long straight lines, there's no trades. So there's long periods of time where this particular bond does not trade. And so the markets in New Zealand are quite illiquid. Let's take one that was actually traded. Here's one that's traded. Another Auckland International Airport. Again, one trade today, but there's a bid, okay, but there's no offers. So there's people who want to buy, but nobody wants to sell these things. So today, there's no trading going on. Well, there was one trade, basically cleaned out whoever wanted to sell, that sold, and there's nothing left to sell. And so when we look at our New Zealand market, liquidity is very low, and of course that poses a liquidity risk to us. And of course, in this market, you would want some sort of liquidity premium because of this. Any question on that before we move on? Yeah, go ahead.
Is it the liquidity risk including the yield maturity? Do you want to just work it out the bond price right now? Does it include the liquidity risk?
Yeah, this yield here, this is someone who wants to buy at 3.99%. That includes every last risk factor you can think of in there. Okay, so default risk because it's private sector, liquidity risk, every risk you can think of, interest rate risk, all that goes into there, and all you see is a single yield. But within that single yield, there's a whole bunch of factors that have to go into there to setting that yield. And so this person here wants to buy, and that's the yield that they want.
So if there's no ask price,
Yeah.
how you work it out is the seller's going to be the
Well, whoever that seller, so the buyer, you know, they want to buy, they would have to somehow do all that stuff themselves and figure out what on earth they want. Okay, so a lot of the stuff, I mean, when we think about it, you know, if you actually want to work out what the fair interest rate is, taking account of all these risk factors, the basic idea is that you have to work out what is it likely to cost you over the life of the bond, and then that turn that into an interest rate. Now, we don't actually cover how you do that in terms of the maths in this course, but that's the basic idea. In 205, in fact, in 205, we actually do it the other way around. We take a risk premium and turn it into a default risk. So at the second year, we don't cover how to take a risk and turn it into a premium, but we just talk about the general idea. Okay, any other questions?
Can you, since there's a people want to buy, there's no people to ask, people, is it possible you could take advantage of that?
I don't know how you would.
I mean, like, since you have like demand there, and you don't have a supply, and for example, if I have a supply, can I take advantage of it?
Well, you could sell right now at 3.99%. There is a buyer there at 3.99%.
Yeah.
If you want to sell, there's somebody who'll buy at that rate. Okay. So, yeah, you can trade right now if you want to sell, because there's someone there who wants to buy.
If they don't sell, then pretty much this bid price is pretty much lower than I expected. In this case, that's why people don't trade.
Well, now in actual fact, in this type of bond, okay, when we're thinking about how people use government bonds versus corporate bonds, what you see in government bonds is a lot of investors that are big investors in government bonds are buying those bonds for liquidity purposes, and so they will trade them. And that's like when you see in the government bond market in Australia, the average bond used to be traded 9 times per year, and now it's down to 4.5 times per year. They're trading them for liquidity purposes, whereas a lot of the buyers in this type of market are buying purely for investment. Okay. In the government market, you are definitely buying them for investment, but a lot of buyers are buying them because they are easy to trade and can be used for liquidity purposes. Here, you get a lot of buy and hold type investors in here. I mean, most of the people, private investors who buy these things, buy them with the intention of holding them through to maturity, and they never intend to trade them. And that accounts for why the liquidity is so low, because you're having a different style of investor in this market, in the corporate market, than you get in the government market, where people are definitely buying them for liquidity management purposes. Okay, any other questions? Okay, get back to my slides here. Okay, so local government bonds, both in Australia and New Zealand, we have these things. In New Zealand, the regional councils and city councils, sometimes they issue bonds when they need funds. In some parts of the world, these things are not taxed. Certainly not the case here. And so in some places like the United States, a municipal bond is not taxed. And so if you're in a high tax bracket, it's always very advantageous to you to buy municipal bonds. In New Zealand, that's not the case. Every council has its own credit rating, and they pay an interest according to whatever it is. When you ask about how much they might have, this state is getting a bit old, but it's getting a bit old now. But Christchurch had about $14,000 debt per ratepayer. That's about 3 years ago now. So there's still a significant amount, and I think Auckland alone has something like about $4 billion worth of debt on issue at the moment. So they have a lot outstanding. Okay, now I'm going to move to corporate bonds. Okay, so here's a couple of basic types. What's the difference between an unsecured note and a debenture? Yep, go ahead.
Debenture will be backed by some kind of asset. So if the firm goes bankrupt, that asset will be sold. The things that are backed by that debenture will get the proceeds from that sale.
So one of the key things is, most places in the world, New Zealand being a little bit of an exception, is a debenture has some sort of specified security behind it. So in the case that there's a default, the bondholder, as a group, have a right to seize that asset, whatever it may be, and sell it to try to recover funds. The other one, obviously unsecured, there's nothing there to back it up, and you simply become part of the queue of unsecured creditors, hoping that you'll get something out of it if there's a default. Okay, what about the other one? Senior and subordinated debt. What's that? What's the difference there? Yep, go ahead.
It's the priority of your claim against the resources of the company and then the default.
Yeah. So in the case of default, they line the creditors out. Now, where you are in the queue will depend what type of security hold. So if you're a senior bondholder, and there are also subordinated bonds on issue by this same company, the senior ones are in front of the ones, so they will get full 100% payout before the subordinated one gets anything. And of course, the consequence of that is that your risk is lower, and so if you hold senior debt and the company has both senior and subordinated debt, the senior debt has a lower coupon rate, will trade a lower yield because the risk is lower. Let's see, did we miss anything? Yeah, in New Zealand, New Zealand debentures can be secured or unsecured, so if you're going to invest one, it's best to read exactly what the story is with these things, because they may be either. So that, okay. Moving on to provisions for the repayment of capital, because usually when the thing comes to an end of its life, it's got to be repaid. What are common ways of repaying that money? Ooh, nobody knows. All right, we'll roll our. Okay, so there's several ways that it can be repaid. Now, in New Zealand, by far the most common one is the thing they call the balloon payment. And basically, at the end of the life of the bond, the entire thing is repaid in one go. That is how most people think bonds work, and that's because in New Zealand they work that way. Now, in some overseas jurisdictions, there are these alternatives which can be used. In particular, the sinking fund is quite commonly used in the U.S. If you think about the basic problem that the balloon payment makes for the company, what would it be? What's the basic problem with having a balloon payment for a bond issue if you're a company? Yeah, go ahead. Yeah, so because it's going to be a big payout, the problem is building up enough cash to make this big payment. And sometimes that is a problem, particularly if they're not going to roll it over, issue a new bond. So there are all other ways of doing things to try to deal with that problem, and the most common one overseas is a thing that's called a sinking fund. There are several ways that can be used, but basically there's two simple ways. It's two most common ways is that the company pays money into a trust fund, which over the life of the bond ensures that by the time the bond reaches maturity, that trust fund has enough to repay it. So that's known as a sinking fund. The other way is that, and it'll be written into the bond contract, that there's going to be a periodic retirement of bonds, and typically the retirement of these bonds occurs on an annual basis. So if it's a 10-year bond, every year they will retire about 10%. So from the first year, retire 10% of them. Second year, 10%. So by the time it gets to the end, there's only about 10% of them outstanding at the end. We don't see this often in New Zealand, but it's certainly quite common overseas. Now the other two ways we met before, call option and put option. Remember we talked about this in the bond valuation section, and interest rate risk. The call option means that the borrower, that's the issuer, that's the issuer here, and they have the right to retire the bond early if it suits them to do so. So you can get this happening. If the call option is there and they decide to exercise it, they retire the bond early. Put options, the bondholder has the right to require them to take it back, and if it suits them, so the interest rates rise sufficiently, it's worthwhile requiring them to take it back because you're going to invest at a better rate. So those are the common ones. But if you've got an option built into the bond, it really does make the pricing of these bonds much more difficult. Okay, we'll end at that point, and we'll start at this point on Friday. So tomorrow's lecture is the review. So if you have questions, let me know, and I'll try to deal with them tomorrow. Okay, if you want to ask your questions, be around for a while. Otherwise, see you tomorrow or Friday.
Is it ever common for, say, like government-issued bonds and stuff to have called back, or is that really not?
Government ones tend to be very simple in structure. They don't have call options and put options in them. They tend to be very plain, generic type bonds. So there's no what's there. Yeah, that's it. They're very simple bonds. Yeah, it tends to be corporate ones that have these things and stuff in it.
Sometimes I'm about to start doing practice quizzes. I'm in practice like the old CSS words we used to.
Oh yeah.
Can you want to just knowing the material?
Well, the past test and then the blank pages and one answers. When the style of questions are basically the same style, level difficult about the same, and of course the material is the same. So you can answer those ones.
Jerry, can we just stick now? Will we wait for him? Jerry, can we just wait for him? Yeah, it's good. I'm bring Pierre from here.
Because how many is there in Kevin?
Well, I've got 5 to complete, so we can just run it with 5, but I want to get another 1 and 2.
So when you say you like got like $2,000 on it.
So we can just...
Yeah, but
Where
so do you think you do it from your students?
Oh, we're using 4 companies contracts. So 4 in the contract, that's 2. We're going to underwrite 2. So we're 500.
Yeah. And what about the other 1K in 500?
The 500, yeah, they're just going to underwrite. Because one company, the total not comfortable.
Oh no. Because 500K. Is it only doing 500 each? Like the 4 that you did?
Yeah.
How much time